that's an actual program. The United States is the world's largest holder of gold reserves. We have 261 million ounces, and we have been carrying them since February 1973 at a book value at Treasury, and also recorded on the Fed's balance sheet as being worth $11 billion at $42.22 an ounce. There's a tremendous windfall profit to be captured if we were to mark those to market. And this is now being discussed in many realms because people are seeing that gold is approaching $3,000 an ounce. There's close to $3 trillion worth of windfall profit. What I'm suggesting is, first, I don't want someone to get the bright idea to just sell off our gold and take that money and give it to Treasury.
The United States holds the world's largest gold reserves, totaling 261 million ounces. Since 1973, these reserves have been recorded at a book value of $11 billion, based on an outdated price of $422 per ounce. With gold nearing $3,000 an ounce, an unrealized windfall profit of nearly $3 trillion. Some are now discussing marking these reserves to market, but there's concern that the government might sell off the gold to cover deficits. Instead, the focus should be on securing these holdings rather than using them as a temporary financial fix. Dr. Judy Shelton, a prominent economist and monetary policy expert, said that a practical solution to the financial challenges facing the U.S. is marking its gold reserves to market and using them as collateral for long-term treasury bonds. The U.S. holds 261 million ounces of gold, currently valued at an outdated $422 per ounce, while gold nears $3,000. Instead of selling off these reserves to cover deficits, a better approach is to issue gold-backed bonds. These bonds would function like Treasury inflation-protected securities, TIPS, allowing holders to redeem them at face value or in gold at maturity. This move could restore confidence in the dollar, attract investors, and provide a stable, cost-effective way for the U.S. government to borrow. As you watch these clips, we encourage you to like this video, subscribe to our channel, and hit the notification bell so you're instantly alerted whenever we post new content. We appreciate your support and hope you enjoy the video.
I see that as a win-win initiative that is actually doable. It's one thing for someone such as myself to criticize the Federal Reserve. But if you really want to have something concrete happen, to draw attention to the burden that works against individuals in the United States, when you have fiscal and monetary policy that empowers government, that reduces purchasing power through no fault of their own. People have to deal with inflation, and that then requires the Federal Reserve to ratchet up interest rates. So it's a double whammy for the average American, paying higher interest rates and having to deal with inflation. If you want to change the arc of that unsustainable situation, you have to do something. The United States is the world's largest holder of gold reserves. We have 261 million ounces, and we have been carrying them since February 1973 at a book value at Treasury, and also recorded on the Fed's balance sheet as being worth $11 billion at $42.22 an ounce. There's a tremendous windfall profit to be captured if we were to mark those to market. And this is now being discussed in many realms because people are seeing that gold is approaching $3,000 an ounce. There's close to $3 trillion worth of windfall profit. What I'm suggesting is, first, I don't want someone to get the bright idea to just sell off our gold and take that money and give it to Treasury. And here we are running these massive deficits. To me, that's sending it down a rat hole. No. I want to make sure that can't happen. I want to lock up our gold holdings by marking them to market, but holding them as specific collateral and issuing long-term Treasury bonds. That alone will get the world's attention. A relinking of the U.S. dollar to gold after over 50 years. And these should be made available to bondholders, and essentially the instrument, it would work much like a Treasury inflation-protected security, a TIPS bond does today. It would be saying you're willing to make a loan to the U.S. government, but you're concerned about the possibility that purchasing power will go down over the life of the bond. Now, TIPS bond pays back, gives additional compensation in addition to the real rate of return based on the consumer price index. So you get compensated for unanticipated inflation in addition to just making a loan to the U.S. government. What a gold-backed bond would do is say, at maturity, you can redeem your instrument in either the face value amount or a pre-specified amount of gold, let's say an ounce. And that would be for the bondholder the equivalent of a U.S. Treasury security and a futures option on gold. I think such an instrument would be oversubscribed and would end up being a very efficient and inexpensive way.
Dr. Judy Shelton explains that introducing gold-backed treasury bonds would provide a more precise measure of future dollar purchasing power than traditional treasuries. Investors would likely pay a premium for the option to be repaid in gold, which many view as a more reliable indicator of economic stability than the Consumer Price Index, CPI. This initiative could shift fiscal policy toward balanced budgets and monetary policy toward price stability rather than persistent inflation. Additionally, using gold as a benchmark for currency valuation would highlight disparities in global trade and economic policy, offering a more neutral standard for exchange rate comparisons. Dr. Judy Shelton highlights that currency misalignment among major U.S. trade partners such as Mexico, Canada, the EU, Japan, and China has given these countries an unfair trade advantage. While the U.S. dollar has also depreciated, it has done so slower than these other currencies, distorting trade balances. For instance, the Mexican peso devalued by 23% against the dollar in 2024, making Mexican imports significantly cheaper. With central banks in Europe and other regions signaling looser monetary policy while the Federal Reserve remains cautious, exchange rate shifts will continue impacting trade. Addressing this imbalance through gold-based valuation or tariffs could help level the playing field. Now, let's recall the interview.
But even more importantly, this would serve as a barometer. We could start to look at the yield on a gold-backed treasury offering compared to a traditional treasury offering. And that would show aggregate expectations about the future purchasing power of the dollar, because it would reflect what a premium bondholders would pay to know that they would have the option to be repaid in gold, which for a lot of people is even better than the CPI, because they look at a loss of dollar purchasing power with gold as kind of a surrogate for the real economy and for commodities in general, and not just a number compiled by the Bureau of Labor Statistics. So I think that would be very worthy and apropos as we enter this golden age under President Trump. It seems an ideal time to launch such an initiative and have it out there and say, we want fiscal policy to do better. We want to move toward a balanced budget. We want monetary policy to move toward stable prices and not just continual inflation, even at a low rate. We don't want that steady erosion of our legal tender. I think it could be held up as an ideal. And to our trading partners, if you start to measure the variance between the dollar's value in terms of gold compared to these other currencies, you get a very clear-cut picture. If you look over the last decade at how the currencies of our 5 major trade partners, that would be Mexico, Canada, European Union, Japan, and China, how their currencies have been debased relative to gold. Even though the United States dollar has also depreciated, ours has performed the best against that standard. And that begins to say, whether it was intentional or not, the currency misalignment has given an unfair trade advantage to our trade partners. And there needs to be some kind of compensation, probably most straightforwardly in the form of a tariff, just to bring us up to a level monetary international playing field. And just one brief example, just in 2024, the Mexican peso, and Mexico is our largest trade partner, depreciated 23% against the US dollar. So even if you're talking about a 25% tariff, that would barely start to compensate for the pricing advantage of products coming in from Mexico that come in 23% cheaper because of that currency impact. You could avoid by just looking at call gold the neutral reference asset. Then you don't even have to say, we're questioning your monetary policy. Currency manipulation is carried out by central banks these days. And all of those same countries, our major trading partners, their central banks are all signaling looser monetary policy coming up at a time when our own central bank is saying we're taking a wait and see attitude. The European Central Bank is talking about a 2% target interest rate by the summer. And here we are at 4.4. So you start to see how these misalignments, which are conducted by having different interest rate targets carried out by other central banks, have immediate effects in the exchange rates. And those exchange rates substantially shift the terms of trade when it comes to imports and exports of goods and services.
By leveraging its gold reserves as collateral for long-term bonds, the U.S. could strengthen fiscal stability, restore confidence in the dollar, and mitigate the risks of inflation and currency manipulation. A gold-backed financial system would provide a more transparent and reliable measure of economic value, ensuring long-term global trade and monetary policy stability. How would issuing gold-backed treasury bonds impact global investor confidence in the U.S. economy? Could a shift toward gold-backed assets reduce reliance on fiat currencies and central bank interventions? Share your thoughts in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.